All right, we have more changes unfolding in the U.S. economy and over at the United States Treasury. Changes that saw a sudden and quite profound crash in interest rates. Rates across the board have been falling. Bond markets feeling the whiplash of traders covering their shorts. And why is that? What has changed? Well, we have some answers after the shadowy, low profile group of banksters who advised Treasury, the TBAC, released their Treasury recommendations report last week. And we have a copy of it, something that you're going to want to see because it answers what just happened to yields this past week and why it happened. Realize this report was written before yields began falling. It was written for Janet Yellen, for Treasury, as a guide for how to stop the run up in interest rates, how to help them buy themselves some time. I'll tell you, there's always more than meets the eye. But before we get started, press the like button and consider subscribing. It helps me out, helps out the channel, and I appreciate your support. So the Department of the U.S. Treasury, folks, run by Janet Yellen, President Biden's hand-picked Treasury Secretary, the person who is technically responsible for collecting all of our taxes as the IRS falls under the purview of the department, managing the nation's debt as well, and paying all of our country's bills. Someone who has proven herself to be inadequate for the position, which you'll see why in a minute. But in reality, Janet Yellen is just a front man, a front woman, a public face, and nothing more. The people who actually decide Treasury policy or technically advise the clueless leadership team over there at the Treasury is a small, shadowy group of people, a low-profile group of banksters called the Treasury Borrowing Advisory Committee, also known as TBAC. They're the people who are pulling the strings. And we know this because of the report that they just released saying as much, warning Janet Yellen and the leadership team over there at Treasury that the level of borrowing, or technically the consistent increased coupon size of their auctions, are a problem, and gave her a blueprint how to stop interest rates from rising, stop term premium from rising. And it appears that she followed their instructions, folks, or their advice to the letter. Now, before we look at this, as there's a few lines in particular that you really need to see that all but explain what just happened this past week, what caused the drop in interest rates. But first, why does the government care? What are they like? Why are they against higher interest rates? Realize we're not talking about the Federal Reserve here. We're talking about the U.S. government. Two different things, right? The Fed wants higher for longer. The Treasury, on the other hand, has a completely different goal. Their objective, last week at least, was to stop bond yields from surging. But why was that? Because they can't afford it. Take a look at this. Our national debt sitting at $33.6 trillion right now, which is more, by the way, than the combined GDPs of Japan, Germany, India, and China combined. A month ago, we crossed 33 trillion in debt, and since then, we've borrowed another 600 billion. This is where we are right now, today. Well, according to the Congressional Budget Office, look where we're headed, folks. By 2033, in 10 years, the CBO projects we'll add an additional $20 trillion to our debt load, bringing us to over 53 trillion. Now, if that's not bad enough, something else happened over the last 18 months that has a lot of people worried about our fiscal sanity. Not only Wall Street, who, by the way, has been putting fiscal excess at the top of their risk calculations recently. For example, take a listen to one of the best traders of all time, hedge fund titan Stanley Druckenmiller, worth over $6 billion. Take a listen to his take on this. Here he is. And that's not just a one off, folks. Wall Street in general has been growing more and more concerned with fiscal excess, this unsustainable path that we're clearly on. It puts their returns at risk, which is why they're worried about it. We saw it translate to Fitch downgrading U.S. debt a few months ago. Well, after the recent surge in interest rates, it got government's attention as well. For starters, this TBAC group, the Treasury Borrowing Advisory Committee, who spelled it out for Janet Yellen and the clueless economists at the Treasury 2 weeks ago, before yields started falling and before Treasury released their Q4 borrowing plan. And what was it that caught their attention? The cost of servicing this debt, folks, exploded after the Treasury's most recent auction size increase. Remember, we spoke about that last week in a video. The Treasury released their Q4 borrowing plan to borrow over $1.5 trillion this quarter in Q4 and Q1 of next year, an absolute insane amount of money. Well, that's not free to do. Just like all of us normal folk have to pay interest on our debt, 29% APR on credit cards right now. Well, the government does as well. Take a look at this. Interest payments to service our national debt. Only the interest expense just crossed $1 trillion for the first time ever, 1.027 trillion. And that's at an average rate of just 3.096%. That's it. You see the problem here, right? Now, the higher rates go, the more they rise, the more unsustainable it gets. So in this report that's meant to advise Janet Yellen on what to do, they specifically mention this and advise her what she has to do immediately to buy themselves some time. Not fix it, not solve the problem, but buy time. Writing this: large and ongoing deficits have fed expectations of significant supply increases. The U.S. fiscal deficit is at the top end of its range, outside of recession, periods of high unemployment. A very high deficit, despite a strong economy, puts stronger focus on government borrowing. They don't want that. And they go on to say this, and just realize they know this report's going to be seen by the public, right? Which is why the wording is so watered down, but they specifically answer the question why yields have been rising so fast, saying this: yields rose following Treasury borrowing estimate and supply announcements during Q3. And they lay out the timeline of what's been happening. Look at this, showing how Janet Yellen's auction size announcements have been moving the market. Writing this: in August, the Treasury announced larger than expected borrowing estimates and sizable coupon issuance increases across maturities. Then 10-year yields rose sharply after each announcement. The immediate increase following the auction size announcement was bigger, despite changes that were largely in line with primary dealer expectations and TBAC recommendations. Again, TBAC is the group who's deciding all this. Janet Yellen, just does what they say. And they add this: the Fitch rating downgrade on August 1st may have added to overall negative sentiment, but yields did not move on the announcement. Instead, it's all about the market being worried about you increasing the size of these auctions, talking to Janet Yellen, borrowing too much money, fiscal excess, right? Now, here's where it gets interesting. In August, Janet Yellen's Treasury told all of us that further gradual increases to coupon auction sizes will be necessary in future quarters. That's what she wrote. Well, in their new borrowing plan, they changed the wording, clearly at the direction of the TBAC. They changed the wording from future quarters to only one additional quarter. And that's what happened. That one line seemed to make all the difference. Immediately after Treasury released this new borrowing plan is when we saw all that short covering begin. So why did they do that? Well, the TBAC explains that as well, writing this: if Treasury were to keep the same pattern, now they're talking to the Treasury here, okay? They say if Treasury were to keep the same pattern of increases announced in August for the next 2 quarters, auction sizes in most benchmark tenors would rise to a new record high. This would lift the duration of Treasury supply substantially higher next year as well. So to summarize, the TBAC realized that the recent spike in term premium was far too expensive to continue, and they needed to rein it in. They explained that to Janet Yellen, told her how to slow it down, simply just change the wording in next week's borrowing plan so the market believes there won't be any additional borrowing increases after next quarter. And she listened to them. Mission accomplished. They successfully kicked the can down the road. But folks, realistically, the can is coming, right? There's no way to stop it at this point. The only thing that they could do to buy even more time, if they get desperate enough, is to force the Fed to cut the overnight rate hard and fast, which they're going to eventually need to do. If it was up to the government, they'd probably have done that a long time ago, as it serves the current administration's interest, but it doesn't serve the interest of the Fed. The Federal Reserve needs to keep rates higher for longer to accomplish their mandate of 2% inflation. So we have these two sides butting heads here. Luckily, it's not the Fed's job to worry about our national debt. It's the Treasury's job and the executive branch's job. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.